morning, welcome to Ainsley News. It's Thursday the 11th of February. Today we're talking junk bonds record and a gold coiled spring. Gold rose last night despite weaker than expected inflation data out of the US, which saw the USD continue its slide and bond yields dip even further as expectations of even more monetary stimulus were essentially locked in. The core CPI print missed market expectations of a 0.2% rise for January by remaining unchanged. Coincidentally, Fed Chairman Powell released a statement yesterday warning of a faltering recovery, stating, "Despite the surprising speed of recovery early on, we are still very far from a strong labour market whose benefits are broadly shared," and stating they will continue patiently printing, or in Fed speak, a patiently accommodative monetary policy stance, printing machine, of course, and again reiterating that Biden has to help with fiscal stimulus, stating it will require a society-wide commitment with contributions from across government and the private sector. One such commitment from the private sector could be blindly buying up junk bonds at an unprecedented rate to drive down yields on even the poorest rated debt instruments. Well, the private sector is happy to oblige, ironically called high-yield bonds, or more colloquially called junk bonds. The money pouring into them has seen yields drop below 4% for the first time in history. This little chart here showing that US bond yield over quite a long period, and we're dipping below that lowest point there. Even the junkiest of junk, the CCC rated bonds, are exploding in both price, and hence low yield, and issuance. So to be clear, despite a lot more supply or money supply, the yields have hit an all-time low, and buyers are happy with that risk for just a 6.7 return. Here's some charts here. CCC supply has seen a surge in activity, and CCC yields are now at record lows comparatively. These are indeed extraordinary times. In yesterday's discussion points, we listed all the record positionings in financial markets right now. The king of paper financial assets is the US Treasury bond. This next chart we're going to show you is worth revisiting as a reminder that we've never, in 670 years of history, seen the interest bearable on a reserve government bond issued lower than what it is now. Check out this chart here. It's actually fascinating as this goes back to 1350. Travels all the way through time up to around 2020. Goes through the Dutch perpetual bonds, the Genoa Republic, the perpetual bond in the UK, the US 10-year Treasury note as well. And right now, we're sitting at an all-time low. And so despite still currently low inflation, we still have real interest rates, or nominal, less inflation, surging deeper into negative territory. Historically, gold has enjoyed a strong inverted correlation with real interest rates. Gold investors have been scratching their heads since the top in August last year, at a market chopping generally downwards amid all these seemingly fundamental drivers for gold price. Likewise, bond yields had been on the increase until recently reversing. The everything is awesome risk-on trade was king. However, this next chart we're going to show you illustrates clearly the coiled spring that is the gold price when charted against those real interest rates. Check out this chart here, gold versus real yields, and what's really going on there. We might be about to see some more directly related correlation to that soon. Remember, ainsleyBullion.com.au for all things physical, gold, silver and platinum. ainsleywealth.com.au for all things cryptocurrency and the gold silver standard. Check that out at goldsilverstandard.com, built and backed by Ainsley and securely stored at Reserve Vault. We'll catch you tomorrow for more news.